Good morning, everyone. Thank you for joining us today. We're just going to wait a couple minutes for the stragglers to kind of hop on before we get started. Okay, we gave them about 3 minutes, so let's get started. My name is Abigail Del Riesco. I am the External Affairs Coordinator here at the ORA, and I'm so happy that you could join us today for today's webinar. Don't leave money on the table, commonly missed tax opportunities for 2023. Just a few housekeeping things. If you have any questions, please feel free to put them in the chat or the Q&A, and we will get to them after this presentation. And for any questions that we don't get to during the webinar, we will touch base with you offline. This webinar will be recorded and sent out to you after, so you can send it around to any colleagues or anything like that, or refer to it afterwards. And without further ado, let me introduce our panelists today, Rebecca Shepard and Peter Hochbo. They have helped hundreds of businesses understand qualifications for ERC and other bit relief programs. Yeah, so Peter and Rebecca, if you want to take over and kind of introduce yourself further and get into the presentation, that would be great.
Sure, thank you so much. We're very happy to be here. Peter and I started our careers as tax controversy attorneys. And what that means is we were like defense against the IRS and state taxing authorities in order to help our clients that were small businesses defend sales tax audits, payroll tax liabilities, income tax issues, really anything and everything that was some sort of adversarial position against a taxing authority. Our clients were small businesses that were kind of on the bubble of viability. And when COVID hit, we knew that there was not going to be any way for these companies to remain operating with any kind of break in operations. So we dug down deep into the CARES Act and worked and got our clients PPP. And at first you couldn't use PPP and ERC together. And so we worked to get people the Paycheck Protection Program, made sure their loans were forgivable. So you all remember that stuff changed a million times over the course of the pandemic. And then in December of 2020, Congress changed its mind and said, okay, you can use these two programs together as long as you don't use the same dollar twice. Now, that changed the game for us, and we were able to really look into our clients' profiles and determine who is eligible and get our clients the employee retention credit. This changed the game in that it paid for all of their tax liabilities and gave some of them even some money on top of it, and created this way for us to help small businesses that struggled through the pandemic. So since then, Peter and I have been on this, informational campaign, working with the National Restaurant Association, the Ohio Restaurant Association, in helping people get tax credits, but also like tax planning for the future and how best to position your business, going forward in this post-pandemic world. So with that, I'll send it over to Peter.
Sure. So we're going to start briefly with the employee retention credit, just because part of tax planning is making sure that you did it right. And so if there are issues with claims that have already happened, I assume, the owners and operators that are on this or watching this have heard of the employee retention credit. So we won't, go back and do everything, but let's make sure you did it right. And if there are issues, it's better to, address them up front or earlier rather than later. So as Rebecca said, the legislation changed in December of 20. It changed a couple other times, changing program rules, extending and pulling back and all this stuff. And other than the notices that the IRS put out after that legislation, the government was pretty silent for a really long time about ERC. And it wasn't until October 19th, 2022 that they finally came out with this warning saying, some third parties are taking improper positions related to taxpayer eligibility for and computation of the credit. And reminding folks that improperly claiming ERC could result in taxpayers being required to repay the credit with penalties and interest. And, we are starting to see that, and audits are happening, and the government is not necessarily just accepting narrative statements about why, there is eligibility. They want you to come back behind and quantify it. And to work through some of the tough stuff that may not have happened on the front end. So let's just run through quickly before we move on to some of the other credits and tax planning things that are out there, and just run through what it means to be an eligible employer. I'll throw it back to Rebecca.
So how do you know if you're eligible for the credit? Obviously, a lot of restaurants are eligible, but you guys could have different businesses. Or you might have eligibility that extends past, when your dining room is closed. So let's kind of go through that a little bit. The term eligible employer means an employer which is carrying on a trade or business during the calendar quarter for which the credit is determined. And there are two ways to qualify: either a significant reduction in gross receipts or a suspension of operations or partial restriction due to a governmental order. So the first is the easiest way. And Peter and I tell everyone to do this first because you don't have to get into the government orders. Why bother? Significant reduction in gross receipts. So for 2020, your gross receipts are less than 50% of the gross receipts for the same calendar year quarter, 2019 compared to 2020. So your receipts in 2020 had to drop 50% in order to be eligible. When Congress said you could use these credits together, they also made the credit easier to get and more lucrative. So for 2021, all you need is a 20% drop in gross receipts in order to qualify. Additionally, in 2021, if you drop 20% in Q1 and go up 1,000% in Q2, you still qualify for Q2 due to an alternative quarter election. 2020 has a similar concept with how long you qualify for. You qualify at a 50% drop, and then you remain qualified until the quarter after the quarter where you have a 20% drop. People need to work on how they write things because there's too many words there. But in 2020, most employees are going to max out. 2021, since you're eligible for each quarter, your credit is for each quarter, there's a better opportunity to use this alternative election. So one thing just quickly about that gross receipt analysis, you can qualify based on a reduction in gross receipts, regardless of how that reduction comes into play. So your business closed 3 locations and your revenue drops considerably, that's okay. You lost a contract because on the side you have a government contracting business or who knows, that's okay. It does not have to be tied to COVID-19. However, for the next test, if you don't qualify for all quarters on significant reduction in gross receipts, you then look at the full or partial suspension of a trade or business operations. This is where Peter and I spend, I don't know, 90% of our day arguing and discussing whether or not somebody has had a restriction of operations due to a governmental order. So this is really important. The operation of the trade or business is fully or partially suspended during the calendar quarter due to orders from an appropriate governmental authority limiting commerce, travel, or group meetings due to the coronavirus disease 2019 or COVID-19. So you need a government order, and it has to be because of COVID. A foreign order does not count. We've been on calls before where people talking to us about what happened in China. It doesn't matter. It needs to be a US order, federal, state, or local. The portion of your trade or business is fully or partially suspended if that portion that's suspended is more than a nominal portion of your business. So if we're looking at suspension, meaning let's say a restaurant, indoor dining is suspended, you cannot have anyone in your dining rooms, that is a portion of your business that is fully suspended. So in order to determine how much of your business that is, you have to look back to 2019. Is it more than 10% of your revenue in Q2 of 2019? Yes. Then the fact that you couldn't open your dining room in Q2 of 2020 means that you had a more than nominal portion of your business that was suspended due to a governmental order. When you have a full suspension of operations, it's easier than when you have a partial restriction. So in about June of 2020, July of 2020, things started to open up a little bit, and restaurants could have dining rooms open, but had 6-foot social distancing, extra sanitation. There are these modifications that had to be taken in order to be able to operate those dining rooms. So now the question is, did those restrictions have more than a nominal effect on your ability to provide goods and services in the normal course? Now we're not just looking at indoor dining, we're looking at your DoorDash, your delivery, your drive-through, and whether or not your capacity limitations or your 6-foot social distancing or sanitation had more than a nominal effect, 10% again, of your ability to provide goods and services. So if you could have 20 tables before, now you're down to 10 because you have 50% capacity restriction. You have to look at your numbers and make a determination of whether or not you qualify. This is a facts and circumstances test. And if anyone tells you that you automatically qualify through blah, blah, blah date, that should raise your spidey senses a little bit. That should make you curious about how that's possible that you can automatically qualify when it's a facts and circumstances test, and everyone's facts and circumstances are different.
So assuming, the folks looking at this and watching this have already filed, I mean, hopefully you realize that this should have been an ongoing conversation that you had with the preparer. It's not, I can qualify you in 4 minutes after answering a couple of questions online and not, having a conversation with someone. This is where this stuff gets really hard. The nominal effect analysis is not straightforward, and you do have to work through tough stuff, even restaurants, for sure. So let's see, where's my clicker? There is actually a third method of eligibility called a recovery startup. This is very, fact intensive. By definition, a recovery startup business began operations after February 15th, 2020. If you were before, just definitionally, you can't be a recovery startup business. The average gross receipts of the business need to be less than $1 million. That can get tricky if you have controlled groups. By definition, then you can't qualify under method 1 or method 2, the significant decline or the partial suspension of trade or business operations. And then recovery startup business is only available for Q3 and Q4 of 2021. It is the only way to qualify in Q4 of 2021. So basically, what is this? You took a risk and you opened a business during a pandemic, you survived, you grew, you had employees in Q3 and Q4 That's the very specific fact pattern for that third method of eligibility. And then just quickly, again, to impress upon you that this stuff's hard. So they took the employee retention credit, they overlaid it onto a bunch of other tricky tax stuff, things like controlled groups and affiliated service groups, where issues are aggregated and you have to consider it, the one employer for purposes of the credit. It changes the way that you do the analysis for the significant decline in gross receipts. It affects full-time employee counts. There are really tricky family attribution rules. So you have to understand, what does a husband own or two spouses own? Do they have minor children? And by the way, minor children are not defined as 18, they're 21. And so we have weird conversations with folks about, do they have any kids who are 20? This is that ongoing conversation that you need to have with the preparer to work through these things. Additionally, just some sort of housekeeping issues, but the refund statute expiration date, so this is the due date in case you haven't filed, is for credits related to 2020 is April 15th, 2024. For credits related to 2021, they have to be filed by April 15th, 2025. Interestingly, the assessment statute expiration date lines up with those in most circumstances. So for quarters 2 of 20 through quarter 2 of 2021, they have 3 years from filing the original Form 941. So if you filed it timely, the assessment date, so how long the government has to come back in and audit and assess additional tax, for 2020 calendar quarters is going to be April 15th, 2024. For the first 2 quarters of 2021, it's going to be April 15th, 2025. In the American Rescue Plan, Congress gave themselves an extra 2 years for quarters 3 and quarter 4. So in those 2 quarters, they have until April 15th, 2027. Again, this is if you timely filed. So, and then lastly, tax treatment. You need to make sure that you're paying tax. So the Code Section 280CA principles apply. Basically says that if you receive a credit based on wages paid, you lose the deduction for those wages up to the amount of the credit. The government has come back behind and said that their interpretation of the regs under 280C is that it requires special tracing. So that means that they tell you to go back and amend your 2020 or 2021 business income tax return to pay tax on those wages or that net income, as opposed to paying tax when you receive it. So make sure that that's another issue that you're working through with the preparer, either the preparer who did the ERC or your regular preparer. All right, so that is the end of ERC. We're sure that you have heard about it and probably claimed it, but make sure you did it right. If you have concerns, certainly feel free to reach out and talk through, your specific issue. Moving on.
Just really quick, all this stuff, we know we just flew through stuff that gets kind of tricky and sticky and complicated. And somebody said I was eligible through September 30th of 2021. Now I'm curious. And I'll say this again, but just call us. We're happy to talk it through. Even if you've already claimed it, you're not going to be a client. It's no problem. We really don't mind. And we just want to make sure everyone's doing it properly.
Yeah. So the rest of this presentation, just some other ideas, other things that may work for your restaurant. One is the work opportunity tax credit, also called WOTC. It was set to expire, but then also reinitiated December 27th, 2020. That's the same legislation that sort of turned ERC on its head, and it's for wages paid before December 31st, 2025. So this is not going to be as lucrative. It's not the $26,000 refundable tax credit per employee, but generally it's $2,400 per employee. It can be as high as $9,600 per employee, but the general rule is that it's 40% of qualified wages. Generally, qualified wages are capped at $6,000. there are certain categories of these targeted groups that they're looking for, where qualified wages can go up to 24,000. And that would lead to 40% of 24,000 is 9,600. This is not a refundable tax credit, right? So they're not going to send you, the government's not going to send you a check, but it is a dollar for dollar offset of a federal tax liability. So it's a credit, not a deduction. So, if we all weren't so jaded from the big numbers that are coming out of ERC, this is a pretty good deal. And if you can avoid having to pay $2,400 or $9,600, why not? You've got to work for it a little bit. And we'll talk through exactly what you have to do there, but real quick, and we'll share the slides, or, these are the targeted groups. So we won't go through all the definitions, but qualified 4A recipient, qualified veteran, qualified ex-felons, designated community residents, vocational rehab referrals, summer youth employees, SNAP benefit recipients, SSI recipients, long-term family assistant recipients, qualified long-term unemployment recipients. So, those are the targeted groups that the government has said, look, these people have faced significant barriers to full employment. We're going to put out this credit to employers who hire them. But as I said, you have to work for it a little bit. So an employer must pre-screen and obtain certification from an appropriate designated local agency, also called a state workforce agency, that the employee is a member of a targeted group in order to claim WOTC. So what does that mean? So each state has its designated state workforce agency. There's someone in Ohio, and I can help you track down that person, that is reviewing this. And you're sending this form 8850. This is the pre-screening notice and certification request for work opportunity credit to that state workforce agency. And on this form are 4 dates, and you've got to make sure that you're doing them in the right order, that you're documenting this stuff. But you need the date that the applicant gave you the information about them being a member of a targeted group. You need the date when the job was offered. You need the date when the applicant was hired, and then the date when they started the job. And then you have to make sure that you turn this in within 28 days after the individual begins work. And eventually the state workforce agency will say, yes, we agree. And then you're done. And how do you claim the credit? You're claiming it on form 5884, which rolls up into form 3800, which rolls up into whatever tax return you're otherwise filing. Could be a 1040 and a Schedule C if you're a sole proprietor. We'll talk about why that's not a great idea later on. Form 1065 if you're a partnership, C Corp 1120, or if you're an S Corp, which we'll talk about why that's probably a good idea, 1120S. So again, this is not refundable. They're not mailing you checks for this, but you can carry it back 1 year and then forward up to 20. So chances are you'll get an opportunity to use the credit and offset that tax. Back to Rebecca.
Yes. So this is kind of like what we're talking about now is like high level, what you should be talking about with your accountant. It's kind of like end of year tax planning, but it's May 31st of June. So you're getting a big jump on it. You're going to get 6 months in order to figure out what's best for you and what's best for your company. So when you buy something for your business, you typically get to expense it over the course of its life. So if I don't actually know very much about ovens and stuff, but let's say an oven's useful life is 5 years. Maybe it's 10, maybe it's 20, I don't really know. Let's say 5. So if you have an oven that you purchase and its useful life is 5 years, you would take 20% deduction as an expense each year. Well, there's other ways to do that. You can do something called a bonus depreciation, which allows you to take, now that it's after January 1st, 2023, you can take 80% of that expense in year 1. mostly what tax attorneys do and accountants is try to get you to pay tax later rather than earlier. So anytime you can write off something this year, that's when you should do it. Unless there's something else going on, you think you're actually going to make more money next year, you're gonna make a different bracket, you know, that kind of thing. But most of the time, it's better to pay less now. So we would tell you to look at bonus depreciation as one way to do that. So if you're going to buy an oven, buy it December rather than January. So that way you get to write it off in this year, take it as an expense on this year. And like I said, take that 80% instead of over its useful life. Go next. So then there's something called a Section 179 expense, which allows for immediate expense deduction similar to bonus depreciation, but there's parameters. So it's cars, office equipment, business machinery, computers. The maximum amount in 2022 was a little over $1 million. You're probably safe with an oven. I don't know how much these things cost, but I'm assuming less than $1 million. But it depends on what you're doing and what you're looking at and whether or not it makes sense to use a 179 expense or to use bonus depreciation. If you buy a car for a business, you must be using it for business purposes more than 50% of the time. That one gets misconstrued sometimes, where people buy a car for their business and don't realize that they actually, it's just their personal vehicle they're taking to work. It's not the same thing. So look at that a little more closely. Talk to your accountant about whether you should take bonus depreciation, 179 expense, whether or not you should expense over the course of the useful life. We're just giving you things to think about so that way you can plan a little better and hopefully, you know, pay less tax. Go to the next slide. Research and development credit. A lot of restaurants, bars, bakeries don't realize that they might actually qualify for like a techie research and development credit. Research and development credit is a federal tax credit available to organizations that invest in qualified research and development activities. The credit provides dollar for dollar cash savings for performing activities related to the development, design, or improvement of products, processes, formulas, or software. Excuse me. Next slide. So in order to qualify for the research and development tax credit, and this is big picture, high level, make sure you're having a conversation with somebody before you start trying to claim these credits to make sure you qualify. But just to give you guys an idea of things that might qualify, if your cafe is starting to roll out, get it? Sorry. Thank you.
Yeah. I heard it.
Roll out a new bread for a grocery store, a local grocery store. You might now need to think about, okay, how do I get the bread to stay fresh for an extra 5 days? What do I need to tinker with to keep the taste and keep the product and its integrity, but also make it so it has a better shelf life? Well, now you have an opportunity to possibly get the research and development tax credit. So you first need to make sure you have a permitted purpose. So an activity is intended to develop new or improved business component. So improving function, performance, quality, or reliability. It can be a product, process, technique, formula, or software. I don't know how many of y'all actually created your own app or anything like that as far as food delivery and food pickup and that type of thing during the pandemic, but I know some restaurants did. That would certainly qualify for the permitted purpose piece of it, just to be clear. You know, again, make sure that you're talking about somebody specifically with these types of things, but that's certainly something that you could look at to determine whether or not you can get the credit. So elimination of uncertainties, prong 2, an activity intended to eliminate technical uncertainty concerning capability, optimal methodology, appropriate design, process, or product improvement. So you can't just know it's going to work. You have to test it to make sure. That's one of the elements of the test. Go to the next slide. So again, process of experimentation, your implementation of a systematic approach to identify and evaluate different alternatives to achieve the desired result by trying different technologies, several iterations, modeling, and simulation. So again, a baker, a brewer, for those that they brew their own beer or make their own wine, all of these types of, creating this process goes through this process, most likely, and could very well be eligible for this credit. So the other piece is it needs to be technological in nature. So you have to apply hard science principles such as engineering, physics, chemistry, computer science, or other disciplines. Chemistry and physics, I think, really overlap a lot with people who are creating food and drinks and that type of thing. Things to be on the lookout for. Anyone have any questions? Okay, we will continue.
So,
Yes.
is this me?
Yeah, I think
it's me. Sort of starting back with fundamentals, your choice of entity is important because it has implications for how you're taxed. And some choices are more tax efficient than others, but there's a give and take. So let's just walk through, the simplest form is a sole proprietor, meaning it's just your individual. And similar to that is a single member LLC, which for federal tax purposes is a disregarded entity. So the government's going to treat you as if it's just you. Still better to be a single member LLC versus a sole proprietor because of limited liability. So if you don't have some sort of entity in place, you certainly should get one. But sole proprietor, single member LLC, disregarded entities are extremely tax inefficient because you are paying both income tax and self-employment tax on all of your earnings. So then you go down from that and you say, well, what if I had a partnership? Partnership files on 1065. That's also pretty inefficient because you are again still paying self-employment tax on the pass-through income. So then looking at corporations, there's two types. There's a subchapter C and a subchapter S. After TCJA, the Trump tax cuts, C Corps became more tax efficient than they were because their rate was lowered, but still not as efficient as an S corporation. So, C Corps still some inefficiency because both the C Corp pays tax, and then when money is distributed out as a dividend, the individual pays tax as well. S corporation works a little bit differently, where you are required to pay yourself a salary, and as a result, you only pay income tax on the pass-through income. So you're no longer paying self-employment tax that a partnership is paying. You're no longer paying tax on dividends that a C Corp is paying. But in exchange, you have to pay yourself that reasonable salary. What is a reasonable salary? It is what a similarly situated person in a similar location is being paid for the same work. That can be hard. I can tell you that the answer is not $5,000 a year. It is more. And these are issues that are open for audit. And they do come in and they do reasonable comp audits and look at that kind of stuff. So
especially with employee retention credit audits, people talk about those audits all the time. And well, if I file, will this like open me up for audit? And most people are talking about, is it going to open you up for an income tax audit? But what it does is opening you up for a payroll tax audit. And one thing payroll tax auditors are trained in is reasonable comp. So there's something to think about.
Yep.
This is me.
This is you.
Yeah. Dramatic pause. Pass through entity considerations. So things to think about, and I'm not sure what the rule is in Ohio, but certainly something to look into is when TCJA passed, as a lot of you know, you are no longer able to claim all of the state and local income tax that you pay, including property tax, as a deduction on your Schedule A. So there was a $10,000 cap on your state and local income tax itemized deduction. What some states have done is work out different opportunities for residents so they can really not be, so that that limit isn't devastating. Some states have said like your entity, your PTE, so again, not a sole prop, but your partnership, your S corporation can actually pay its state and local income tax on behalf of the corporation. And because of that, you're actually getting that whole benefit, and it's going to flow through on your K-1 because it's a business expense. So you're going to have less income in there. You'll have already paid the tax and you'll claim the estimated payment that the business made on your behalf. There's 5 partners. Each one will take, its share of the estimated payments that are paid. Things to think about, again, this is stuff to talk to an accountant about, see whether or not you can qualify. When this stuff came into play in Maryland, Peter and I gave, I don't know, a few webinars on it, a few talks, and we were actually pretty shocked by how few people, one, were in a proper entity that had a business. Like, if you have a sidewalk coming up to your business, you should have an LLC, or you should have some sort of structure that's going to protect you so you don't get sued personally when somebody trips and falls on their way into your business. And then also, like he was saying, for planning purposes, how you can take a salary and pay payroll tax with that, and pay, just income tax on the profit. There's just different ways to do it. None of these strategies are going to make you like a millionaire overnight, but every time you can save $5,000, $10,000, $15,000, it's a good day. It's worth it. So it's certainly things to take into consideration and talk to a tax professional about. This is us.
Thank you guys so much for that wonderful presentation. I feel like I learned so much from it.
Oh, good.
Yeah, it is good. So we'll just wait a couple minutes and see if any questions come through the Q&A or the chat. But in the meantime, I was actually curious about something. Rebecca, you talked about bonus depreciation and taking the 80% off in the first year. What does it look like every year after that? Is it 20% then, or is it 10% because you take more the first year, or what does that kind of look like?
So that's a good question. And I believe the next year you would take the 20%.
Got it.
And then, yeah, going forward, it would just be fully expensed. And
okay, great. I was just wondering about that when you brought it up in the presentation, because that's great that you can take off so much in the first year.
It phases out in 2027, I believe.
Got it. So it's like,
It's going down.
It's going to keep going down 20%. But what tends to happen, I think, is whenever it gets to the point where it's actually going to phase out, is they redo it.
Got it. Got it. Okay.
Congress claims to hate tax, but they sure tinker quite a bit.
Yeah. So it looks like we don't have any further questions. So that just proves to you guys that you explained everything perfectly. But we will also provide both of your contact information when we send out the recording afterwards. So if anybody has follow-up questions, they can reach out to you personally. But thank you both for taking the time today to sit down and present this for us. And thank you all for joining us today. And I hope you guys have a great rest of your week.
Same to you. Thank you so much. Take care.